This is Radio Free Wall Street with Lee Adler, on the web at radiofreewallstreet.fm and wallstreetexaminer.com. Hi everybody, this is Radio Free Wall Street for Monday, November 11th, 2014. It is 4:30 p.m. New York time, and the S&P 500 closed up about 6.5 points to another record close, 2038. That is just 6 points away from the 6-7 week cycle projection of 2044. That spitting distance, 6 points, remember, is now only 0.3%. So 6 points isn't much. I think it's a done deal that we see that 2044. Now, this area in here around 2040, 2044 is where a long-term trend line connecting tops going back a year or so on the S&P 500 is situated. I think we looked at that chart last week. And the market's due for a pause here, but we can't rule out that it's just going to go barreling right through this resistance area. In that case, we'd be looking at cycle projections on the 13-week cycle and the 8-week cycle of like 2070 or 2090. I certainly wouldn't rule out those targets at this point. There were a couple of things in the news today I wanted to bring up. Some of those I wrote about this morning on the free side of the Wall Street Examiner. One, a few central bankers and money managers get it, Yellen and Kuroda don't. There was a report from a central bankers meeting that was sponsored by the Bank of France in Paris last week. Quoting Bloomberg, a couple of the central bankers and major investors that spoke there complained about QE and ZIRP, and what the article said was that among the gripes, central bank stimulus has relieved pressure on governments to revamp their economies, punished savers, inflated asset bubbles, and left financial markets overly reliant on liquidity and prone to volatility when it reverses. So it seems like thought leaders are beginning to catch up with yours truly and other critics of QE who have been making these complaints for years that QE and ZIRP reward financial engineering and are a disincentive to real investment and real growth. So it seems like the mainstream is beginning to move in this direction. That doesn't mean that there's going to be a change imminently, but it does mean that there is going to be a change. So I would guess within a year or so, and many of the forecasters are predicting higher interest rates in 2015. But more importantly, the question is, when is the Bank of Japan going to stop pumping money into this one world liquidity pool? I think that's the big issue. When the BOJ stops is when the game changes. Now, the ECB is continuing to attempt to refill the pool, but so far with little success. The fact that the ECB has stopped shrinking its balance sheet, however, means that it is no longer a drag on the system, so that the whatever the BOJ pumps in, while the Fed is sitting on its hands and the ECB is basically maintaining the level of its balance sheet, all that BOJ cash is excess liquidity that will flow towards the U.S. as it always does, and will flow into U.S. equities, the last Ponzi game standing. Now, another issue that came up this morning that I picked up on Bloomberg was, I called it that certain barnyard smell. What I said was that anyone who has ever lived around a farm or taken a Sunday drive through farmlands will recognize this smell. It has the same pungency. And I was talking about a quote, again in a Bloomberg piece about the Treasury market, that said, for all the talk that U.S. Treasuries will tumble once the Federal Reserve starts to raise interest rates, investors in the longest dated debt securities are finding little cause for concern. And I think that that is one of those statements that is going to stand out for a long time. We're going to look back on this as sort of a bell ringer that the the consensus about bond yields was too complacent. Look, the Fed had been purchasing or financing the purchase of 70 or 80 billion dollars a month in new US Treasury debt that was being issued every month. Now, the level of new debt is shrinking. It's only maybe 50 or 60 billion a month on average, but every quarter there's 1 month where the government runs a surplus. So there's 2 months in every quarter where we still have 80 or 90 billion in net new supply that has to be absorbed, and we're not getting any help from the Fed anymore. So unless there are other buyers who are going to step up and absorb this regular flow of new Treasury debt, or unless the U.S. economy is going to grow so fast that the deficit is going to disappear and there isn't any new supply, then there's going to be new supply to be absorbed, and there is going to be less demand than there had been in the past. That demand had been supplied by the Fed or financed by the Fed. That's going away now. So I think that on the basis of liquidity flows, we need to expect that there will be some increases in long-term rates. Lo and behold, today, the yield on the 10-year Treasury did uptick all day long, along with stock prices. Keep an eye on that 245 level on the 10-year. I think if we tick through that and hold above that level, then that long-term downtrend that we've been in for the last year in the 10-year yield is probably, or has probably, come to an end. So keep an eye on that. There were a couple of news items on the banking regulatory front that I think are related. It was reported that the Financial Stability Board in Basel is passing a new capital requirement that will require the world's largest banks to have an enormous capital cushion that will enable them to be wound down in the event of a systemic crisis without resorting to public bailouts. The requirements will call for capital ratios of about 16 to 21%, which are much larger than the required capital the banks are required to carry today. Now, here's the thing. At the same time, Bloomberg reported late Friday that the Fed is once again caving to the wishes of its member banks. Now that they've held out this long, they expect that their newly bought and paid for Congress will make the pesky Dodd-Frank rules go away. And this is in regard to changes to Dodd-Frank that could ease requirements on the Volcker Rules trading restrictions. And Bloomberg reported that Scott Alvarez, the Federal Reserve's general counsel, said that the central bank is reviewing whether to extend a deadline for implementing the Volcker Rule and changing metrics used in the regulation. He said that a rule requiring banks to separate their derivatives trading from units that benefit from federal backstops should be revisited. So in other words, bankers have not only avoided punishment for their massive frauds that caused the financial collapse, they engineered their own rescue via central banks, and now they've made any attempt at systemic reform disappear as well. So it's just a matter of the banks who control the district Federal Reserve banks and basically control the political process now as well, have rendered themselves immune from any kind of punishment, any kind of regulation, simply by buying their way into the pockets of the regulators and the politicians. So these new rules that have been proposed out of Basel, the Financial Stability Board, are not supposed to take effect until 2019. That's more than enough time for these big banks to, again, water down any proposed rules that would prevent them from causing another systemic meltdown. So I think that it's just a matter of time until this thing happens again. But for the serial crash callers, a matter of time could be a very long time, and that's why we track these liquidity flows into the markets and we do technical analysis to evaluate whether the danger is imminent or not. And at this point, the danger does not appear imminent. So now let's take a brief look at the Fed's balance sheet for this week, in particular the liability section. I want to talk to you again about the term deposit facility and what's going on there and the relevance that that has to the idea that the Fed is going to be able to raise interest rates at some point next year. So let's take a quick look at the all-important liability side of the Fed's balance sheet. Why is it all important? Well, because the Fed's liabilities are effectively money. The base money is called reserves, and on the Fed's balance sheet they call that other deposits held by depository institutions. This is basically the bank's checking account at the Fed, and it amounts to $2.6 trillion. Fed's total liabilities are $4.43 trillion. And when you start to think about it, there really isn't that much difference between these reserve accounts and the Fed's term deposit facility, which is 7-day money, and the reverse repos, which are overnight money. The banks have access to these funds whenever they want. They're excess funds at this point. They really have no use for them. So effectively reducing excess reserves by shifting the cash into other accounts on the liability side of the Fed's balance sheet really has no impact on the ability of banks to operate or on the impact of this cash on the financial system. Now, last week, the Fed actually printed $7.9 billion in ones, fives, tens, 20s, 50s, and hundreds that it packed up on pallets and shipped out of the district banks to banks around the country for the beginning of the holiday season. The second item on the liability side is the Fed's reverse repos. That changes, those amounts change daily. There's a $300 billion ceiling right now. And as of Wednesday, November 5th, the total reverse repos outstanding was $225 billion. That actually includes some reverse repos to foreign entities. The direct reverse repos to domestic entities was somewhat less than that, but that program is limited to $300 billion. In January, the Fed is going to add another reverse repo program, 7-day term, with a maximum of $300 billion. So it's at various points, the Fed could move as much as $600 billion out of these direct deposit accounts into these overnight or 7-day term reverse repos. But again, it's all short-term money to the banks that they can't do anything with anyway. So it has no real impact on the amount of excess cash in the system. Then every week the Fed is doing these term deposits. This is almost like a bank CD for the banks. The current amount shown is $219 billion, but last week the Fed did a term deposit facility of $262 billion. Since that didn't settle on until Thursday, that $262 billion won't show up until next week. The Fed paid 26 basis points on the $262 billion, and this week's operation will go up to 27 basis points. If the Fed is paying 27 basis points, according to the pundits, that should be the floor on interest rates. But money market rates are still pinned at 3 or 4 basis points. That includes both the very short-term T-bills and commercial paper, extremely low. So the term deposit facility has no impact on money market rates. The Fed is paying 26 basis points when the market is 3 or 4 basis points. This is a direct giveaway to the banks. Remember, this is cash that the Fed injected into the banks in the first place when it bought treasuries and mortgage-backed securities from the banks. This is cash that didn't exist before, and it goes to the banks, and now the banks are collecting interest on it. Nice work if you can get it. There's your $2.6 trillion in excess reserves, other deposits held by depository institutions, and then there's $104 billion in the Treasuries account at the Fed. The Treasury Borrowing Advisory Committee a couple of weeks ago recommended that the Treasury build a rainy day fund of $500 billion. And in fact, the Treasury is moving in that direction. $104 billion balance at that point in November is extremely high relative to where the Treasury's balances usually are. That's because they've been collecting more in taxes, but they've also been increasing the size of their short-term bill offerings. This effectively does take cash out of the banking system, and it reduces the reserve accounts because the investors buy this paper, it goes into the Treasury, and then it disappears. So if they build a $500 billion reserve, that's going to reduce these excess reserves by another $500 billion, bring it down to $2.1 trillion. And if they increase the term deposits a little higher, they can bring this down more, and they can bring the reverse repos up as high as 600 billion. So maybe they can get this number down to 2 trillion or so. But most of that is going to be sitting up here in these reverse repos and in the term deposits. So that's not going to actually reduce the amount of cash in the system. This amount, this 104 billion going to 500 billion, would actually suck some reserves out of the system. But it's still going to leave 2.1 trillion or so, or a very large amount of cash still sloshing around the banking system. The banks are going to be competing with each other. And if the Fed is paying them a subsidy of 26 basis points, that actually lowers their cost of funds. So why wouldn't they compete more aggressively to lend money at retail? The Fed's policy of actually paying interest on reserves may backfire because it lowers the cost of funds of the banking system. So these are just a few thoughts on the Fed's liability side of its balance sheet. And I keep track of this weekly in the Wall Street Examiner Professional Edition in the Fed Report. And if you aren't subscribed to that, I think it's something that's worthwhile to keep an eye on. So I invite you to give the Professional Edition a try so you can track this every week. So that will do it for today. Next week we'll get together later in the week. I'll be traveling Monday and Tuesday. As a matter of fact, I'm leaving tomorrow for a pilgrimage to my hometown of Philadelphia that you see on this backdrop behind me. We're going home to spend some time with my extended family and to celebrate my mother's life. As you are aware, she passed away a few weeks ago. So I'll be offline for much of this week. The Wall Street Examiner Professional Edition and the free articles on the Wall Street Examiner will be very limited, if published at all. And then next week, again, our next Radio Free Wall Street will be later in the week. I'll post a notice on the Wall Street Examiner and on Radio Free Wall Street when to expect that, but it probably won't be before Thursday or Friday. So until late next week, have a great week, trade sane, and I'll see you next week.